Meet Masa, a very business-minded kid studying at University of California, Berkeley. He invented an electronic translator, which he sold for $1.7 million at the age of 19. If that's not impressive enough, and I think it should be, he was also importing used video game machines from Japan and installing them in dorms and restaurants, earning him another $1.5 million. And if even that's not impressive enough, soon after graduating, he founded a video game company called Unison World and sold it for nearly $2 million when he was just 23 years old. I think this is the most impressive guy under the age of 25 that I've learned about to date. At 24 years old, he takes $50,000 and founds a new company called SoftBank, meaning software bank, and they started to gain recognition by investing and acquiring struggling tech companies. This business approach of Masa's seemed contrarian to a lot of people and highly risky, but it was working. That's the thing. His $20 million investment in Alibaba turned into over $100 billion. With those kind of numbers, he was rocking a reputation as a bold visionary, and he was so young. Next thing you know, Masa's starting up the Vision Fund through SoftBank. This fund had a strategy of identifying and backing companies with disruptive potential in the technology sector. It was a venture capitalist fund, which Masa referred to as a, quote, vision capitalist fund, highlighting his belief in the transformative power of technology to shape the future. Now, things continued going really good for Masa and his endeavors, and his success seemed untouchable. But then Vision Fund's aggressive investment strategy and relaxed due diligence started to bite Masa in the butt. A typical investment was significant, often exceeding $100 million. And any investment that they would choose made a ton of other people play into this herd mentality. Countless investors copying Masa's investment decisions. Vision Fund had begun investing money with an unwavering belief in their ability to identify winning companies. Essentially, they had won too consistently and grew overconfident. This led to them overlooking risk. You see, Vision Fund desired not just to move quickly, but also at a high volume. And this priority of speed came at the expense of due diligence. This resulted in an increase in investments in companies with questionable business practices, weak structure, and unsustainable growth trajectories. So in 2022, there was a global economic slowdown, which exposed Vision Fund as being overly invested in high growth companies that either had low earnings or no earnings at all. All of this led to the loss of $32 billion for the fiscal year ending in March 2023. I guess they should have embraced being bored a little bit more and slowed down to research the companies they were investing in and the people running those companies. But of course, you never really know when the whole global economy is going to go cold on you for a while. And they weren't really ready for that.